Have you ever asked yourself, what should I do if I don't have a single dollar to my name, but still want to change my life? It sounds like a simple question, yet I believe more than half of us have felt lost thinking about it. We live in a world where the word investment is tied to big numbers, skyscrapers, and names like Warren Buffett. And so, holding a copy of Rich Dad Poor Dad, many of us have come to believe that in order to achieve financial freedom, we must become an entrepreneur or an investor. The problem is, most of us misunderstand from the starting line. Poor people often think investing means using money to make more money. Sounds logical, right? But for the wealthy, investing isn't just about money, it's a strategy. A game with many pieces: time, energy, skills, relationships, and they arrange these pieces in a way that makes winning almost certain. I remember the first time I heard about Buffett. I thought, he just buys stocks, waits for the price to go up, and gets rich. But in reality, he's running a business, setting up an entire game board. Meanwhile, when we buy a stock thinking we're investing like Buffett, we're actually joining a game where the rules aren't ours. And in that game, small players like us are more likely to be prey than predator. So the first thing I want you to understand is this: real investing requires capital, and not all capital is money. You can invest your knowledge, your time, and most importantly, your relationships. But if someone tells you, you can invest without money, in a way that sounds like quick buy sell profit, be careful. What you're doing might just be speculation, a gamble where you don't fully understand the risk. In this video, I won't just talk to you about how to make money or get rich quick. I want to take you on a journey from having nothing to stepping into the world of investing without falling into traps, and ultimately reaching financial freedom. We'll talk about the difference between starting a business and investing, about the principles of the wealthy, about how to cross the investment threshold, and the secret of using other people's money to build your own wealth. If you've ever wondered, where should I start? Then this is the place. Let me tell you a story, not just mine, but of many people who started from zero and stepped into a completely different world. And maybe, just maybe, this story will be the map you've been searching for. I want to start this part with a question. If tomorrow morning you received $30 and had to invest it, what would you do? Buy stocks? Open a coffee shop? Or leave it in the bank for safety? It sounds simple, but your answer will reveal something important, whether you think like an entrepreneur or an investor. The difference between these two concepts is so important that, if you don't get it, you could spend your whole life going in the wrong direction. Entrepreneurship means you create a product, service, or business model, and you run it day by day. You have to worry about everything: finding customers, maintaining quality, managing costs, fixing problems. In contrast, investing means putting capital into an opportunity that someone else runs, while you focus only on the return. It sounds easy to distinguish, but in reality, many people confuse the two. I have a friend who wanted to open a restaurant for tourists. He described everything in detail, from renting a location, decorating, buying kitchen equipment, to his marketing plan. Finally, he asked me, "Do you think this is a good investment?" And I knew immediately he was standing at a crossroads without realizing it. Why? Because he wasn't really investing, he was starting a business. He would have to deal with every bill, every shift, every customer review. This means putting all of his time, energy, and money into one project. If it succeeds, the profit could be great. But if it fails, he loses everything. This isn't investing, it's a gamble where you're the only player holding all the risk. The problem is, many people don't realize they're gambling. They think they're investors, but in reality, they're self-employed with a big chunk of capital. And when you put all your capital, both money and energy, into yourself, the risk isn't just in the market. It's in your health, your mindset, and your resilience. Think about it. If you had $1 billion, would you still want to stand in the kitchen, sweep floors, or count every single dollar? Absolutely not. At that point, you would think like an investor. Find the best people to run things, while you oversee results and look for the next opportunity. That's why I always advise, if you're just starting out and don't have much capital, be clear whether you're starting a business or investing. If it's entrepreneurship, prepare yourself to do almost everything. If it's investing, make sure you have a clear plan, measure the risks, and never put all your eggs in one basket. And most importantly, remember this: entrepreneurship can be the path to creating your initial capital. But it's not the final destination. The destination, if you want financial freedom, is to become an investor, someone not tied to a specific job, but using your capital, or other people's capital, to create sustainable profit. Once you understand the difference between starting a business and investing, the next question is, so how do wealthy people actually invest? This is where we talk about two core principles that almost anyone at the upper levels of wealth applies. Principle number 1. Don't use your own money to start a business. Sounds counterintuitive. You might think starting a business means using your own capital. But the wealthy understand that their own money is a precious resource to be preserved. When launching a project, they often raise capital from others, investors, venture funds, or even bank loans, instead of pulling it out of their own pocket. I once heard a successful entrepreneur say, "If my project needs capital, I'll borrow it. My responsibility is to multiply that money. The lender's responsibility is to ensure their cash flow remains stable." It may sound cold, but this is how they keep their risk at a minimum. Principle number 2. Only run businesses that require little to no capital. You'll notice models like real estate brokering, drop shipping online, or consulting services. These models allow you to earn money without a large upfront investment, or sometimes with almost no capital at all. Today, the key to making money with no capital is the internet. A strong social media account, a YouTube channel, or a well-listened podcast. These are digital assets that can generate huge income. Imagine this: if you have 1 million followers, and a brand wants to advertise to them, even at just $1 per person, you've made $1 million. This is also why the wealthy often see personal branding as a form of long-term investment. They don't just build companies, they build their names, a brand asset that can open more doors than any bank deposit ever could. But why are these two principles so important? Because they allow the wealthy to step away from the labor trap. They're not stuck doing everything to make money. They focus on creating systems where money moves and multiplies on its own. Many people ask me, "But if I have nothing, why would anyone invest in me?" The answer lies in the value you bring. The wealthy don't pour money into promises, they invest in a clear plan. In a person they believe can turn an idea into reality. So before you seek funding, ask yourself, what value am I bringing that others need so much they're willing to pull out their wallets? When you can answer that, you'll understand why the wealthy's principle always starts with holding on to their own money and using other people's money to expand opportunities. Investing isn't just having money and putting it somewhere. In reality, investing is a field with a threshold, and this threshold isn't measured by how much money you have, but by the mindset you hold. I used to think that as long as I had capital, I would automatically become an investor. But I later realized, if you don't understand the rules of the game, the money in your hand is just bait for someone else's profit. Take people like Warren Buffett or Bill Gates. Do you think they use their own pocket money to invest? Not at all. They use other people's money through fundraising, selling shares, or bringing in investment funds. Buffett runs Berkshire Hathaway not just as a company, but as a capital-raising machine. He attracts thousands of shareholders, pools their money, and uses it to invest in big deals. Profits are shared, but the decision-making power stays with him. This is where the investment threshold lies. You must shift roles from being someone who takes money to look for opportunities, to someone who has opportunities and looks for money. When you're in the second position, you're playing on the true investor's field. I once met a friend who started a tech business. He didn't have a single dollar, but he had a promising prototype. Instead of waiting to save enough to launch, he went to venture capital firms. 6 months later, he secured millions in funding. He didn't just cross the threshold, he jumped into an entirely different level of play. The interesting thing is, to raise capital successfully, you don't necessarily need a running company. What you need is a clear value proposition, showing why their money will generate returns, and why you're the one person who can make it happen. Ask yourself, if you had $1 million, who would you hand it to for investment? You'd choose someone who makes you believe they know exactly what they're doing. This is exactly how big investors think, and why they only fund those who've crossed this mindset threshold. Once you understand this, you'll see that raising capital isn't begging. It's a high-level business skill, where you're offering someone the opportunity to make money with you. And that is the gateway into the real world of investing. A world where you don't have to drain your personal resources, but can scale up, reduce risk, and increase profits, all because you know how to find the money first. Spend it later. When I talk about investing without losing, many people laugh. If there's no risk, how can there be high returns? But in reality, wise investors don't start with the question, how much can I make? They start with, how can I not lose money? The formula is simple, yet rarely practiced. Use other people's money. Invest in an opportunity with a high probability of success, and minimize the risk as much as possible. Think about venture capital funds. They have hundreds of millions of dollars to pour into thousands of projects each year. They know full well that 90% of them will fail. But if just one project turns out to be an Alibaba or a Tesla, the profits will cover all the losses and then some. So what does this mean for us, those without millions in hand? It means we need to choose projects much more carefully than they do. If they can accept a 90% risk, we should be looking for opportunities with at least a 70 to 80% chance of success. Example: you want to buy a rental property. Instead of relying on a feeling that this area is hot, you need to calculate purchase price, renovation costs, expected rental income, and payback time. If the numbers show that you'll definitely recover your investment in 10 years, and every dollar after that is profit, then this is a form of no-loss investing, because even if the market fluctuates, you still have steady cash flow. Or in online business, you don't buy inventory up front but use a made-to-order model, print on demand. Drop shipping. You only produce when the customer has already paid. The risk is close to zero because you have no unsold stock. But for this formula to work, you need one crucial element: the ability to evaluate opportunities. This is a skill that beginners often overlook. They jump into markets because they see others making money, without analyzing whether they can replicate that success. I once spoke to a friend who invested in a coffee shop just because the one next door was always full. 6 months later, he closed. Why? He didn't realize that the other shop was owned by a well-known local family. Customers came not just for the coffee, but because of relationships. The opportunities looked the same, but the conditions for success were entirely different. No-loss investing isn't about finding a miracle. It's about doing everything to tilt the odds in your favor. When you use other people's money and ensure a high chance of winning, you're in a position that's both safe and potentially highly profitable. And remember, in investing, sometimes not losing money is already a victory. Because when you preserve your capital, you still have the chance to get back in the game, learn, and do better next time. If you pay attention, world-class investors, Warren Buffett, Masayoshi Son, Jack Ma, all share one thing in common: they don't just invest. They build a machine for investing. Let's take Warren Buffett as an example. People call him the Oracle of Stocks, but that's a brand. A perfect marketing story. In reality, he runs Berkshire Hathaway like a massive company that invests. That company has thousands of shareholders, and they are the ones funding Buffett. Why is this important? Because Buffett doesn't have to pull money out of his personal wallet. He uses other people's money to seek opportunities, and profits are shared accordingly. The control over the game still belongs to him. Masayoshi Son, the head of SoftBank, does the same. Instead of just using his own money, he created the Vision Fund, worth hundreds of billions of dollars, raised from major funds and governments. He doesn't just invest in one company. He creates a strategic investment network where companies in the ecosystem support and push each other forward. Jack Ma is no exception. Alibaba started as an e-commerce company, but it gradually became a super platform, selling products while also investing in other companies to expand its power and influence. What's the common thread here? It's that they don't sell products, they sell businesses. They build companies as investment products, and when they raise capital, they're selling a piece of that company to get money to keep expanding. In other words, investing and raising capital are like two sides of the same coin. You can't just know how to invest without knowing how to raise capital. And vice versa. A good investor must know how to create opportunities and also how to invite others to join. This is why I always say, don't just learn how to pick stocks or evaluate projects, learn how to build a platform that allows you to raise capital whenever you need. Once you have that platform, you're not just a market participant, you're someone who creates the market for yourself. And when you reach this level, you'll realize, money is just a tool. The most valuable thing isn't capital, it's the ability to control capital flow. The richest person isn't the one with the most money, but the one who decides where the money goes, what it does, and who it benefits. When you have nothing in your hands, the road ahead often looks like a towering wall. Many people stand before that wall thinking, I need money before I can start. But the truth is, if you wait until you have enough money, you might be waiting your entire life. I've met so many people with great ideas, but those ideas stay in the drawer because they're waiting for a safe amount of capital to start. Meanwhile, others, even without capital, find ways to get started with time, skills, and creativity, and they are the ones who cross that first wall. The roadmap for those starting from zero doesn't begin with jumping into big projects. It begins with no capital entrepreneurship. This may sound unbelievable, but the internet has lowered the barrier more than ever. You can start with a YouTube channel, a TikTok page, a personal blog, or offering online services. When I say, no capital, I actually mean, no cash capital. But there are other types, knowledge capital, relationship capital, and time capital. If you know how to leverage these three, you can earn your first dollars without making a large upfront investment. For example, I once knew a friend who started by writing articles for foreign blogs. Each piece paid only a few dozen dollars. But he persisted, learned SEO, and eventually started his own content management service. From having nothing, he became the owner of a small agency with dozens of clients. The key point here is, in the early stage, your goal is not to make a lot of money, but to create cash flow. As long as you have a steady flow of money, even if it's small, you've already escaped the standstill state. When you have cash flow, you begin to accumulate capital. And when you have capital, even a small amount, you can start trying the no-loss investment models we discussed earlier. Step by step, you'll move toward the stage of using other people's money to scale up. This roadmap isn't fast, but it's safe and sustainable. From no capital entrepreneurship, right pointing arrow, creating cash flow, right pointing arrow, accumulating capital, right pointing arrow, small investments, right pointing arrow, raising capital to expand. This is the path many successful entrepreneurs have taken, even if they started from zero. And you know what? When you go from nothing to being able to raise capital, you don't just have money, you have credibility. And credibility, once built, will open more doors than any amount of cash ever could. The sad truth is this. Most people who fail in entrepreneurship don't fail because they're lazy, they fail because they start the wrong way. Wrong from the very first step. The most common mistake I see is pouring all their resources into a single attempt. They spend 10 years saving $20 minus $30, then put it all into one shop, one restaurant, or one project they are certain will work this time. But life doesn't follow our script. One slip, a market shift, a new competitor, a sudden pandemic, is enough to bring everything down. And when they lose it all, they don't just lose money, they lose their confidence and their ability to get back up. I once met a man who, after 15 years of working, saved nearly $40. He opened a small eatery, investing every dollar. Less than a year later, it closed because the rented location didn't have the expected foot traffic. He fell into debt, and more importantly, he became so scared that he didn't dare to start again. The second mistake is confusing passion with market opportunity. Many people open a shop because, I like it, not because the market needs it. They love the food they cook, love the product they make, but forget that business isn't a game of hobbies, it's a game of market value. The third mistake is seeing entrepreneurship as the only path to wealth. They believe that as long as they start a company or a shop, they'll be rich. But in reality, entrepreneurship is just one of many paths. And it's not for everyone. This mindset is dangerous because it makes them overlook other investment opportunities, where they could use their skills or small capital to participate without taking on full risk. I always tell beginners, don't put all your eggs in one basket. And don't let your first business be all your hope. Instead, start small, test the idea, and learn from the market. Each attempt is a lesson, not a life or death gamble. Because entrepreneurship, after all, is just part of the journey. The destination is still financial freedom, and to get there, you need more than a single, all-in, bet. Once you've gone through the first steps of your journey, from small entrepreneurship, creating cash flow, to accumulating capital, you'll realize an interesting truth. You don't have to choose a single role. You can be both an entrepreneur and an investor at the same time. This dual mindset doesn't just help you make money, it helps you preserve and multiply it. As an entrepreneur, you create a product or service. As an investor, you create systems so that product or service keeps generating income, even when you're no longer directly involved. Look at how big players operate. They start as entrepreneurs, building a company, testing the market. But when the company reaches a certain scale, they shift to being investors, investing in other companies, or even reinvesting in their own company to scale it further. In other words, when you sell a product, you're selling the value of that product. But when you sell a business, you're selling the ability to continuously create value. And that's what makes investors willing to pay many times more. One example I love. Someone starts a chain of coffee shops. In the early stage, they're an entrepreneur, directly involved in every operation. But as the chain grows, they start franchising the brand. At this point, they become an investor, earning from franchise fees and system profits, without running each shop themselves. This dual mindset also helps you avoid a big mistake: letting your business become your own prison. Many people succeed in business but can't leave it, because everything depends on them. That's not freedom, it's a full-time job in disguise. When you're both an entrepreneur and an investor, you can step outside to see the big picture. You don't just ask, how can I sell more, but also, how can this system run on its own and generate long-term profit? And ultimately, the dual mindset gives you a rare advantage: the power of choice. You can choose to be hands-on when needed, or step back to invest in new opportunities. This is how you expand your influence while keeping your freedom, both in time and finances. After everything we've talked about, from the difference between entrepreneurship and investing, the principles of the wealthy, the mindset threshold, the no-loss investing formula, the strategies of the giants, the roadmap for those starting from zero, the mistakes to avoid, to the dual mindset, I want you to remember one thing. Financial freedom doesn't start with money, it starts with mindset. Money can be lost, but the right mindset will help you earn it back. Money can be taken away, but skills and experience can't be stolen. And when you know how to create value, you'll never truly be broke a second time. I've gone from zero, stumbled, lost it all, and started over. Each time, I realized something. You don't need to wait for perfect conditions to start. You just need to begin from where you are, with what you have, and take one step at a time. This path won't always be easy. There will be times you want to quit. But if you keep the perspective of an investor, knowing how to evaluate, preserve capital, and leverage other people's resources, each step will be more certain. And the destination will be closer. And when you reach the point where money is no longer worry, remember, the highest level of spending isn't buying more houses or cars, it's giving back. Charity not only helps others, but it gives you a profound sense of freedom and purpose. So don't just listen and nod. Start today. Write down your idea. Find a no-capital opportunity. Build skills. And connect with people who can walk this journey with you. Small steps will create a long road. If you found value in today's story, share it. Who knows, this single video might be the starting point for someone to change their entire life. And if you want to walk alongside me on the journey to financial freedom, hit subscribe. Turn on the notifications, because what we're about to explore goes far beyond this.